We woke up today with a very bearish sentiment in the markets. That is because Walmart slashed their profit outlook and they send a warning about the state of the American consumer. Now, what we are getting ready for is Microsoft and Google earnings here in after hours, and that is going to dominate the headlines heading into tomorrow. Then we get the Federal Reserve at 2 p.m. and we get the press conference at 2:30 p.m. So those really three things are going to move the markets over the next 2 days, or call it the next day of trading for Wednesday. And then on Thursday you have Apple and Amazon, and that is pretty much going to conclude this earnings season and give us that trajectory in the markets, either a bullish or a bearish response. But today in after hours, that is the start of potentially a big crash or a big rally, and maybe, just maybe, a market bottom. So this is what Walmart had to say. The key points: the big box retailers said everyday necessities are eating up more household budgets and leaving shoppers less money to spend on items they want, such as new clothing. The announcement raised concerns about shifting consumer behavior and whether inflation has brought pandemic-fueled shopping sprees to an end. Major retailers, including Walmart and Macy's, are scheduled to report earnings in mid-August. So this is not really something Walmart usually does. It's like 10 years since Walmart has came out and cut guidance before earnings. Usually Walmart does not do that, and Walmart is seen as a bellwether. That's in quotes what CNBC and other people are saying, as a bellwether to economic activity. So what Walmart essentially said is people are not really buying electronics as much. They're not really buying clothing as much. They're not buying things that you could skip on. They're spending money on more food products, more things that they need to get by. And Walmart does a lot of business. Over 50% of Walmart's business is food. And they did say that more people are turning to Walmart because they are known for the lowest prices. But that is going to hurt the overall profit margins because food and your necessities have much lower profit margins than your electronics. A TV, for an example, has a lot higher of a profit margin than a frozen pizza you put in the oven, right? So that was not good. That's what initially sent the markets down today, and now people are just getting ready for earnings. If we take a look at what we have for earnings here in after hours, we do have Google, Microsoft, and Google is Alphabet, Microsoft, Visa, Enphase, Chipotle, Texas Instruments, Skechers, Boyd, and Mator. And obviously the big three, I would say, is Visa, Microsoft, and Alphabet. Visa, really people want to know, how is that credit looking? How's credit card usage? Are people using credit cards more? Are they paying their balances as often, or are people starting to miss payments? That is going to be seen as a pretty good gauge to economic activity. And then obviously Microsoft and Google, I probably don't even need to clarify this, but they are the over $1 trillion companies, the first ones we have gotten so far, and that's going to be very important. Does Google suffer the same fate as Snapchat? Are advertisers just slowing down across the board? And we'll get that information today. And same thing with Microsoft. How is their cloud business doing? Those are going to be the key things. And tomorrow, pre-market, you do have Shopify, Boeing, Spotify, Waste Management, Bristol Myers Squibb, Sherwin-Williams, Tech, Hilton, Humana, and Kraft Heinz. So I think we're going to get a pretty big market reaction based off of these earnings here in after hours, especially if Google suffers the same fate as it did last earnings, going down. I believe it was 10%, 15% the day following earnings. If something like that were to happen this time around, well, it's not going to be such a good scenario, and people might start to look at Apple and Amazon and expect, bad earnings, and that could help drag us down. And then depending on what the Fed says tomorrow, the Fed is really going to be the thing, I think, that could give us a lot of bullishness or potentially give us a lot more bearishness. And a lot of people are starting to say, well, maybe the Fed indicates that they're only going to raise rates 50 basis points at the September meeting, or even less than that, or just not raise rates at the September meeting, since this rate hike, if we get 75 basis points, will put us in between 2.25 to 2.5 5%. That is the neutral rate. Well, how much more, is the Fed going to go? That's what the markets really want to know. And I think the Fed's probably going to go more aggressive. They're going to continue on the same pace, at least, that they are doing right now, because in all reality, inflation is 9.1%. So that's obviously not good, right? We need to get that number way down, and the Fed is not going to let the markets just rally here based off of an expectation of they're not going to raise rates as aggressively, because what's that going to do? Well, that's going to encourage more spending. That is going to possibly mean lower bond yields, as people won't expect as many rate hikes, and that would ease economic tightening, and that's the last thing the Fed wants to do right now. And I think it's pretty clear. Specifically, the last thing the Fed wants to do is repeat what happened in the 70s and the 80s by, cutting interest rates once you went into a recession. Inflation kept going higher, and then ultimately the Fed had to raise rates midway through the recession during 1974, and then inflation did fall, but it remained sticky. And then what happened? Well, inflation came back with a vengeance during the 80s, and then the Fed really had to get interest rates super, super high to bring down that inflation. That's because they took their foot off the gas too early during the 70s. So I don't think the Fed is stupid, and I think the Fed pretty much knows what they need to do, and that is, pedal to the metal. Let's beat inflation. We'll deal with economic growth or slowing down of growth, after. And that's ultimately, what the Fed probably wants is a slight recession. Once you get slight recessions or even deep recessions, you will get deflation. You'll get the price of oil coming down, the price of everything coming down. And just like Walmart said, they're starting to slash their prices because people are just not buying as much. So to get rid of that inventory, you pretty much have to. And that should start to help with those inflation readings. Now, on Thursday, we do get the advanced estimate for Q2 GDP. As you guys do know, the latest estimate is still a negative 1.6% GDP print. And I think this could really just be the icing on the cake. If all things go bad, if earnings are bad, the Fed is bad, and we get a technical recession, well, it's not going to be a bullish thing. There's a possibility that you could see bond yields fall. Investors might start to buy bonds a little bit more, and that might be a little bullish, but really ultimately boil everything down in the stock market. The stock market will always revert back to fundamentals. That's why you get the .com crashes. That's why you get, bubbles that pop and never come back, is because when valuations get so high, that's fine, but fundamentals have to back those valuations eventually, and sooner rather than later. So especially in this marketplace, people are not giving stocks the benefit of the doubt. So if it looks like things are bad, the markets are going to discount that as if the situation is already really, really bad. So there you have all that. There was actually news out of Europe with the pipeline as well, with the Gazprom situation, and it doesn't look like it's getting any better. Let's just be honest there. Doesn't look like it's getting any better. Natural gas hits highest level since 2008, on pace for best month ever as Russia cuts supply. This pipeline is only 20% at 20% capacity, and that is obviously a big problem for Europe, and I think that could be something that really comes back to haunt Europe and equity markets later throughout this year once we start to get cold outside, once we start to get to fall and winter. If they don't have enough natural gas, well, obviously that's going to be a big problem. Now, we also did see this bill to boost U.S. chip production and competition with China clears the key Senate hurdle. So that is what kind of caused some of this bullishness intraday today with the S&P 500. You kind of started to get a bounce off the bottom, and it was looking pretty bullish. Now we're starting to head back down, starting to head into lower lows. And I imagine by the end of the day, once we get into earnings with Microsoft and Google, you're probably going to sell off into those earnings just in anticipation of what is to come. A lot of people think that potentially Google is an outlier here and companies are not slowing down advertising across the board. I think they are. I think advertisers are slowing down, just their advertisement campaigns. If people are not spending as much money, if people don't have, $1,000 unemployment checks a week. They don't have stimulus checks. They're not spending as much money. It's simple econ 101. Once you get a big boom in economic activity that is stimulated by things that are not organic, that's not just people working more and spending more, right? It's not organic. That will come down, and it's only a matter of time before that is reflected in company earnings, reflected in consumer behaviors. And what's going to happen when that happens, when consumers really slow down? Well, advertisers are going to slow down. Obviously, they're not going to stop. It's a tax write-off to advertise for your business, but if they take a hit, that means the valuations at these companies are going to take a hit. So depending on what happens, looks like Google could be the one that gets hit a little bit more. Microsoft might be a little bit more insulated, but nonetheless, we will have to see what happens. At the current moment, we are sitting with about $683 billion of margin debt. We are still over $200 billion higher than what we've seen during the March lows. So what we're looking at right now is really portfolios being crunched and condensed in a very big way, meaning that margin has remained very high, and especially really up through May, margin was still at $753 billion. You have seen some hedge funds, some money managers, some individual investors have paid off some of their margin debt. A lot of that was probably selling stocks at a loss, just because the fear that we did see in early June. And that's probably what could mark a bottom if we do get the Fed that is bullish and gives the market that interpretation. But I wouldn't count on that just yet. We have to see inflation come down before we could start to make that gamble. Now for Wednesday, you have durable goods orders, and that is obviously tomorrow, 8:30 in the morning. You do have the Fed 2 o'clock press conference at 2:30. That's going to be the most important thing of this week, to be honest with you guys. That's going to be the utmost importance. It doesn't even matter anything else. Pick one thing here, and it's the Fed. Now, on Thursday, you do have GDP growth rate quarter over quarter advanced for Q2. That's at 8:30 in the morning. Like I said, we're expecting a negative 1.6% GDP print. And depending on what happens there, that could also add a lot more negativity potentially to the stock market. Now, on Friday, you do have personal spending month over month for June and personal income month over month for June. You also have core PCE price index year over year. And I think the Fed at this point, they're not going to signal what they want to do for September. They're going to leave all options on the table. That's where you might get a little bit more of that bearishness. If the Fed says literally that they're going to leave options on the table, that means we could get a 1% hike if the data is bad, or we could get a 25 basis point hike if inflation does start to slow down. And that's the thing, we don't have a Fed meeting for August, so we are going to get 2 CPI prints. We're going to get basically 2 of everything, and that's going to be sufficient enough time for the markets to kind of get a feel of what the Fed is going to do continuing ahead. We're going to get the August CPI, and we're going to get the we're going to get the July CPI, and we're also going to get the August CPI by the time we get to that September 21st Fed meeting. And depending on what happens with the data from here to there, that will be very important to the markets. But ultimately, these earnings, I think, is going to be a very big situation. Now, you also have the 2 to 10 year yield curve that still is inverting, meaning basically, and it's getting deeper, it's now inverted 26 basis points. And basically what this is saying is investors, they are selling the 2-year bonds, they are buying the 10-year bonds. So they expect a Fed error, a Fed policy, aka a recession over the next 2 years, but they think over the next 10 years, inflation will go down and potentially growth will pick up a little bit. So what happens when they sell the 2 years? Well, it's just like selling a dividend stock. If people start to sell a dividend stock, the yield on that dividend stock goes up. And if you start to buy another dividend stock and the price goes down, well, the yield also goes down as well. So that's the best way to look at it, like a dividend stock. So now you can get paid 26 basis points more for a 2-year bond compared to a 10-year bond. So that is pretty much going to be all for this video. I'm not a fortune teller. I don't know what's going to happen with Microsoft and Google earnings, but we are selling off into those earnings. Google down about 3.10%, Microsoft down about 3.5%. So it is not a very good day for the stocks that do report earnings here in after hours. So keep all of this in mind, keep it on your radar, hit that like button and subscribe to the channel if you guys have not already. Comment down below, what is your thoughts on earnings? What do you think is going to happen? Let me know all of that information. You guys enjoy the rest of your day, and I will see you in the next one.